Welcome back to Iron Financial. Listen, right now, big tech is facing some absolutely unprecedented headwinds. We are talking about a volatile macro environment driven by shifting interest rates, and frankly, institutional investors are getting incredibly jittery about these massive valuations. So let's get one thing straight right out of the gate. This is not just another boring earnings recap. This is a dedicated explainer designed specifically to help you forge a stronger portfolio and cut straight through all that market weakness we're seeing. I'm your lead analyst, and today we are executing a very high-stakes mission. We are stress testing the structural integrity of Microsoft's Q3 FY26 financials. We're going to go deep into the revenue, the debt, the margins, and the raw structural data to see if this absolute tech behemoth is standing on solid bedrock or if it's resting on quicksand.
And I'll be your market skeptic today, because let's be honest, we all see the shiny press releases, right? But we need to know what's actually happening beneath the surface. Is this whole AI narrative actually real? Or is it just a bunch of hype masking some serious deep-rooted structural flaws that the broader market is just conveniently ignoring?
Hit the nail on the head. So let's grab our hard hats because we are diving right into the numbers. Okay, well, before we start popping champagne over Q3, let's not pretend we suddenly have amnesia about the $357 billion wipeout Microsoft suffered back in January, right after their Q2 report. I mean, we're talking about a 10% single-day plummet that was literally the worst single-day dollar value loss in the company's entire history. So my question right out of the gate is this. Was that market weakness just a minor tremor, or are we looking at a preview of a much larger structural collapse? Investors have been rattled, and honestly, for good reason. Just think about the sheer psychology of that number. $1/3 trillion. That is roughly the GDP of a small country, and it just vanished into thin air. When a foundational stock loses that kind of capital in a matter of hours, institutional confidence gets totally shattered. You don't just brush that off and buy the dip blindly. No way. You inspect every single inch of the concrete before you step back onto the site. And you know what? That is exactly why we are running this stress test today. Since that massive correction where we saw the stock tumble from an all-time high of around $555 all the way down to a 52-week low near $356, the market has basically fully priced in the most pessimistic, bearish scenarios imaginable. Every single fear about AI monetization, every worry about infrastructure costs, it's all been baked into that lower share price. So the real challenge for our Iron Financial listeners today is to figure out the truth here. Is this stock a value trap that's just waiting to cave in? Or are we actually looking at a generational building opportunity? Because history tells us that when the market overreacts and prices in absolute pessimism, that creates the exact high-stakes environment where real fortunes are forged. But to figure out if the foundation is sound, we have to drill down into the very thing that caused that massive panic in the first place. All right, Section 1, Drilling Down, OpenAI Restructuring. That brings us straight to our first major stress test. We are talking about the highly controversial, highly publicized OpenAI relationship. Back in Q2, Microsoft revealed a commercial backlog that had ballooned to a massive $625 billion. Now that sounds fantastic, right? Until you actually look at the load-bearing walls. Approximately 45% of that backlog, $281 billion to be exact, was tied to a single customer, OpenAI. It's exactly like building a massive skyscraper that relies entirely on just one single steel beam.
Right, and obviously if that one beam buckles, the whole thing comes crashing down. Which leads directly to the core bear argument that the market has been screaming about for months. Back in February 2026, OpenAI actively slashed its compute spending budget for the coming years from a staggering $1.4 trillion all the way down to $600 billion. I mean, slashing $800 billion off a budget? That completely shakes the foundation of Microsoft's projected cash flow. So I really have to ask here, is this $281 billion AI backlog pure hype? Is it made of paper? Because if OpenAI is cutting their compute budget that drastically, how realizable is that backlog really? Can we actually trust that this is real foundational cash flow? Or is Microsoft just booking ghost revenue to prop up their sky-high valuation?
That is the exact structural flaw Wall Street was terrified of. But here's the thing. Microsoft just poured fresh concrete right over that risk. Just 48 hours before this earnings report dropped, on April 27th, Microsoft and OpenAI completely restructured their partnership. Let's take a look at the new blueprint here. Under the old agreement, Microsoft had exclusive rights, sure, but they were locked into a very cash-straining revenue share model where they basically had to pay a cut back to OpenAI. The new agreement fundamentally changes the entire architecture of the deal. First off, the intellectual property license is extended all the way to 2032, but it is now officially non-exclusive. Wait, hold on. Non-exclusive? Meaning OpenAI can just go to AWS or Google Cloud now? How in the world is that not a massive structural weakness for Microsoft? Because it instantly de-risks Microsoft from a legal standpoint. By removing that exclusivity, Microsoft completely neutralizes the massive antitrust targets that regulators in the US and the EU were painting squarely on their backs. And second, and this is the most important part, Microsoft immediately ceases paying any outbound revenue share to OpenAI. Now let me break down exactly why this is a massive structural reinforcement for Microsoft's balance sheet. While Microsoft entirely stops paying OpenAI, OpenAI's revenue share to Microsoft, which sits at about 20%, continues all the way until 2030, just with a set cap. Furthermore, they completely removed the highly volatile artificial general intelligence, or AGI, trigger clauses. Those clauses previously threatened to sever the partnership entirely if AGI was ever achieved.
Market Skeptic. Okay, so let me get this straight. What you're saying is Microsoft engineered a scenario where they cut their cash outflows, kept their cash inflows, and completely neutralized the legal risk of exclusivity all in one swift move?
Precisely. Just think about Microsoft 365 Copilot for a second. That's a $30 per month enterprise subscription. By severing the outbound cash flow to OpenAI, the unit economics and the gross margins of those downstream Copilot products become massively more profitable basically overnight. Plus, regarding your earlier worry, that $281 billion backlog is locked in via existing Azure contractual obligations. Even if OpenAI decides to shift future workloads to other clouds, they still owe Microsoft for the existing contracts. So the reality is, the foundation here is actually way more stable today than it was 6 months ago.
All right, let's move to Section 2, Heavy Lifting, Azure Cloud Growth.
Okay, I'll concede the point on the OpenAI risk. It's clearly better managed and legally fortified now. But let's pivot away from that and look at the absolute core profit engine of the company, Azure. I want to see the raw earnings data here. We really need to know if the top-line revenue is actually doing the heavy lifting, or if the overall infrastructure is starting to sag under the immense weight of all these massive AI expectations.
Well, the data that just hit the tape is absolutely ironclad. Total revenue came in at a staggering $82.9 billion, which completely beat Wall Street's $81.4 billion estimate. That is a solid 18% year-over-year growth, or 15% in constant currency. And let me tell you, we care deeply about that constant currency metric here at Iron Financial. Why? Because foreign exchange rates can be incredibly noisy and often mask the true operational strength of a global business. Even when you strip away all those currency fluctuations, the underlying machine here is expanding at 15%. And the operating income? That reached $38.4 billion, which is up 20%. Honestly, the sheer scale of this cash generation pushes back incredibly hard against any skeptic claiming the company is losing its momentum. What you are looking at here is a fortress balance sheet in action.
And here's the kicker. It's not just legacy software carrying the load anymore. The AI infrastructure is successfully bearing the weight of global enterprise demand. Total AI revenue has officially surpassed a $37 billion annual run rate. That is an explosive 123% year-over-year growth. Just for some context, the last time Microsoft updated this exact figure was back in January 2025, when it was sitting at $13 billion. So in just over a year, they have nearly tripled the foundational strength of their AI revenue pipeline.
Market Skeptic. Okay, I have to admit, seeing a 123% growth rate on a multi-billion-dollar base is incredibly rare. You just don't see that every day. What that implies to me is that enterprise adoption friction is essentially zero right now. Fortune 500 companies aren't just running cute little pilot programs to test out AI anymore. They are completely bypassing the testing phase and paying massive premiums to scale this infrastructure immediately.
Exactly. And this brings us right to the ultimate bull case metric, 39%. That is the constant currency growth rate for Azure and other cloud services this quarter. Management's own guidance, the literal blueprint they gave Wall Street just months ago, was a tier of 37% to 38%. They smashed right through it. Now, you might be wondering, why does this matter so much? Because prior to this, Microsoft was facing a terrifying multi-quarter deceleration trend in Azure. Institutional investors were panicking. They were thinking we had finally hit peak cloud, and that the hypergrowth haze was totally over. Reversing that multi-quarter deceleration and posting a massive 39% growth rate indicates that AI-driven demand pull and capacity expansion are moving in perfect synchronization. They absolutely proved that the core cloud pillar is fundamentally sound. Moving on to Section 3, cracks in the armor. Xbox declines. All right. The commercial cloud is booming, I get it. But let's not pretend this entire structure is completely flawless. I'm taking the reins here for a minute because it's time to expose the cracks in the armor. We seriously need to talk about the consumer-facing side of the business under the new CEO, Asha Sharma. Because while you're busy looking at the penthouse suite of Azure, the basement where Xbox lives is completely flooding. On one side of the ledger, yes, you have the Microsoft Cloud operating with incredible strength, showing 29% growth and pulling in $54.5 billion. But on the exact same earnings report, you have the gaming division actively bleeding out. Overall, Xbox content and services revenue dropped by 5%. And there is a truly devastating metric hiding in there, a 33% drop in Xbox hardware. You really have to ask yourself, is this just a standard cyclical issue at the end of a console lifecycle, or are we looking at a massive, fundamental structural failure in their consumer hardware strategy? And let's be very clear about this. This isn't some one-off anomaly. This is the second consecutive quarter of a 30% or more drop in Xbox hardware. Back in Q2, it was down 31%. Now it's down 33%. The hardware floor is literally caving in. Add to that a 2% decline in Windows OEM and devices revenue, the weakness in the broader PC market is actively compounding the structural stress on the consumer-facing side of the company. So my question to the lead analyst is this. At what point does this dead weight in hardware begin to compromise the broader portfolio's structural integrity? Because you can't just ignore a massive division that is consistently shrinking quarter after quarter.
Good question. Section 4, the cost, capital expenditure analysis. Listen, it's a completely fair point. Gaming is certainly a drag right now, but let's keep perspective. In the grand scheme of an $82 billion quarter, hardware is a relatively small fraction of the total balance sheet. However, you're right to look for structural risks, and that brings us to what is arguably the most critical metric of this entire explainer, the single most important number that every institutional trader was waiting for today, the staggering cost of actually building this AI framework. We are talking about capital expenditures, or CapEx.
Yes, exactly. The CapEx. This is the market's biggest fear. And let's not forget, it's exactly what caused that $357 billion wipeout back in January. Microsoft's full-year FY26 CapEx guidance is a massive $110 billion to $120 billion. That's a huge jump from $80 billion in FY25. The fear on Wall Street is that this is just a runaway train. Let me explain this simply for everyone listening. CapEx is money spent on physical assets, whereas OpEx is day-to-day operational spending. When you are taking tens of billions of dollars in CapEx to buy these $40,000 GPUs, those physical assets have a very short shelf life. They become technologically obsolete and depreciate over just 3 to 5 years. That massive depreciation hits the income statement incredibly hard. If the software revenue doesn't materialize instantly to offset that enormous cost, will this aggressive depreciation pressure cause operating leverage to turn negative? Are they basically building a multi-billion-dollar bridge to nowhere?
That was absolutely the fear. But the actual data that just hit the tape paints a very, very different picture. Q3 CapEx actually came in at $31.9 billion. Now compare that to the previous quarter's $37.5 billion. They actively brought the spend down sequentially. Even better, that $31.9 billion is a full $3.4 billion below Wall Street estimates. Guys, this is an absolute masterclass in capital allocation. It proves definitively that management is not asleep at the wheel. They are actively moderating the pace of their infrastructure build-out to ensure they don't overextend their capital. They are expertly matching the supply of their data centers with the actual demand signal from their customers, rather than just blindly pouring concrete and hoping enterprise clients show up later. Furthermore, Microsoft is highly aware of that exact GPU depreciation risk you just outlined. Let's look at how they actually manage that structural load. Out of that massive CapEx budget, roughly 2/3 goes to short-lived assets, like those GPUs, and 1/3 goes to long-lived assets, like data center buildings and physical real estate. That real estate monetizes over 15 years, providing a long-term structural bedrock. So to offset the painful, short-term depreciation of those GPUs, they are enforcing brutal operational discipline. Just days ago, they announced a 7% workforce reduction, cutting about 8,750 U.S. employees. While obviously painful, from a strict financial engineering standpoint, proactively shrinking labor costs acts as an immediate shock absorber for those rapidly expanding GPU costs. This is exactly how you maintain operating leverage and protect free cash flow stability when you are literally building the most expensive infrastructure in the history of technology.
Finally, Section 5, the verdict, opportunity or trap.
Okay, we've analyzed the blueprints, we've tested the concrete, and we've looked closely at the massive costs of the GPUs. It's time to wrap up this drill down and synthesize all these financials into a definitive, no-nonsense ruling for our iron financial listeners. We asked at the very beginning of this explainer, is the current weakness a value trap? Or is this a generational building opportunity?
I'll lay out the bullish foundation for you. Right now, Microsoft's stock price corresponds to a forward PE ratio of about 22 to 25 times. That is literally the lowest valuation range of the past 3 years. For some context, Apple is trading around 30 times right now, and Microsoft's own 5-year historical average is almost 33 times. The pessimism we talked about earlier, it is already fully priced into the concrete. Add to that a staggering 94% Wall Street buy rating with 0 sell ratings across the board, and a median price target sitting between $575 to $600. So what does universal institutional consensus mean despite a $357 billion wipeout just months prior? It means the smart money sees bedrock. The underlying cloud growth is accelerating to 39%, the AI run rate is an explosive $37 billion, and they brilliantly, legally, and financially restructured their biggest risk in OpenAI. The foundational mechanics here are incredibly sound.
So the numbers clearly suggest an over-engineered fortress. Yes, there is heavy spending, we know that. And yes, we have a flooding basement with the deadweight in the Xbox hardware division. But the absolute bedrock of Azure and the structural brilliance of the OpenAI restructure seem to more than compensate for those cracks in the armor. But look, the final call isn't up to us. It's up to you.
Exactly right. We've brought the blueprints, and we've stress-tested the balance sheet from the top floor all the way down to the foundation. But now you have to apply this explainer stress test to your own trading strategies. Are you ready to do the heavy lifting, or are you going to sit safely on the sidelines while this engineered recovery takes shape and the massive AI capital expenditures actually begin to pay off? We want to leave you with this final critical question. Is your portfolio structurally sound enough to capitalize on this opportunity? Let us know your strategy in the comments, keep your hard hats on, and we will see you on the next deep dive right here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.